G'day, Scott Phillips here, and thank you for joining us for our very first Motley Fool live Q&A via YouTube. Thank you for spending some time with us. I hope you enjoy the next half hour, 45 minutes, even an hour if we go that long. I'm here to share with you some thoughts about what's happening on the market, what's happening in investing, to answer your questions, and hopefully, or I definitely will, release the names of two companies that I am going to buy next before you buy them. So that's really, really important. Of course, at the Motley Fool, you always go first. Now, let me kick off by saying that anything I say in the rest of this presentation is, of course, general financial advice only. It's not personal financial advice. I simply can't do that, nor would I be allowed to do that. So anything you ask, I'll answer to the best of my ability in a general way, but always see a personal financial planner or consider your own circumstances before you do anything based on what you might hear today. All right, so thank you again for joining us. I think we're on. Look what we're on, so we should be okay. I've got one computer down here and one up here, so I will be switching between them as I go to try and keep abreast of the comments. You can, by the way, throw a comment or ask me a question in the chat box, which is over there. Hopefully it's on the right side if the screen's not being reversed. If it is, that's on the other side. Thank you for joining us to have a bit of a chat about what's going on. Let's start with earnings season. Earnings season has been a really fascinating time, and it's fascinating probably in one of those Chinese curse kind of ways, because we're really still in what is now year 3, I think, maybe even the 4th financial year of COVID impacted results. We know, of course, the 2019 financial year completely clean, then 2020 had half a year, 2020, 2021, lockdowns, 22, the same thing. Hopefully, touch wood, the new fiscal year, 2022, 2023, the one we're in already right now, will be the first clean year in 4 years, which will be fantastic. But what it does mean is the results we've seen thus far and the outlook statements we've seen thus far are not only hard to potentially break down, but also if you think about the way they've impacted the results of the organizations, of the businesses, it's going to be a question of where are those individual companies in this part of the cycle. We're seeing some companies that are having a really rough last financial year because they had a great year before that. Other companies had a terrible year last year, and the first few weeks of the new financial year have actually gone really, really well for them. And that's what I mean. We're in this really weird time of trying to work out what is a reasonable base for the earnings potential of the businesses. G'day, Wombat Wood. Thank you. It's time to give up on Koga. I'll get to that one in a second. So yes, it's a really important time to think about what the real underlying earnings power of these businesses are. And that might seem an old-fashioned concept for some people. If it is, then stick with me because I'm going to explain. What's really important is to try and look through as much as we can the ups and downs that are specifically COVID-related. Now, that's not a new concept, by the way. Any business that was cyclical, any business that benefited from or was hurt by one-off factors, you've always got to look through that. You've always got to look to the underlying earnings power of these businesses. Look back 12 months, or even not even 12 months. Qantas was out today with a $1.9 billion loss. Now, it's not going to be that bad every year. I don't recommend Qantas, by the way. I don't think you should buy shares, but Qantas as a business has had a really, really tough last 12 months. Other businesses have gone really, really well. The bounce back for Scentre Group, for example, the business that owns the Westfield shopping centres in Australia and New Zealand, has done really, really well. 8% rise in revenue, 5% rise in foot traffic, 98.8% occupancy. So the bounce back for those guys is already well and truly happening. And so this is where, as an individual investor, as a professional investor, you've got to try and work out where these businesses are. The normal year-on-year growth numbers you might see aren't always as clear or as obvious or as easily attainable, as attainable, I should say, as they might otherwise be. A quick aside, by the way, I'm going to rub my nose a lot today. I've got a bit of a cold. I've dosed up with Codral, but I can't stop myself from sneezing. So I'm going to try desperately not to sneeze. That's going to rub my nose to try and stop me doing that. So please bear with me as I do that. Try not to sneeze down the lens. So yeah, it's really important to think about the underlying earnings power of these businesses and what those growth numbers mean. A business is growing really strongly now. Maybe it's a great business. Maybe structurally it's doing a really, really great job. Or potentially, maybe it's just bouncing back from what was a terrible period a year ago. And you've got to know that. You've got to really have a good sense of it. I'm not a big fan of management kind of coming up with their own numbers. But some of those companies that do say, compound annual growth rate since 2019, for example, it is not necessarily super unreasonable because that was the last base we had. After that, so many ups and downs, really hard to see what's going on. So that's really important. The other thing I want to talk about, of course, I'll go into the details of inflation and rates a little bit later. But when it comes to results, you've really got to also understand the impact of price increases. It's been such a long time, 30 years, since the Australian economy had any meaningful inflation. These days, it's obviously back, we all know that. But the impact on businesses and how you analyze those businesses is really important. If you get a 5% growth rate in the past, you're growing your sales at 5%, you're probably growing the volume of sales, the number of units, the number of customers, whatever those, the volume rather than the value, the dollar value, that was being underpinned by actual customer growth. This time around, we're seeing businesses with, I think Ansel was a while ago, they're out of cycle, I think. They had a 10%, 11% revenue growth, but 10% of that was price. And so, that's not bad, by the way, because they managed to cover their costs. But this is not a growing business in the traditional sense of a growing business. This is a business that simply increased revenues to offset increasing costs. And so you've got to be really careful not to confuse the two. You want to see growing, look, again, better they cover costs than not. But a growing business needs to grow the volume of sales, whether that's the number of contracts, the number of customers, the number of transactions, whatever those actual things are. That's where the value comes from, not the dollar value of those changes. And that's why that's really, really important to have a think about. G'day, Andrew. Thank you, mate. Very kind. Tony, g'day. We'll talk about Domino's in a minute. Woodside, talk about that in a minute. Nearmap. All right, cool. Lots of great questions. I'm going to come back to those in a minute. I'm going to do one more bit of macro-y kind of stuff. Then we'll start answering your questions. If you have the questions, throw them in the box. I think it's just there. It should be. It's where it is on my screen. It's on the other side. I apologize in advance. So let's now talk about inflation and rates, because this is the big, big, big concern, not only in and of themselves, but the impact they might have on the economy. So think about the medium and long-term impact of inflation and interest rates. Firstly, of course, we know things are more expensive. That's obvious, and it will change consumer behavior. Really, really important. Higher prices matter. Prices matter. Now, businesses hopefully have already optimized their prices. If you have to then charge more on top of that, it's very, very likely, particularly while wages aren't growing, that it impacts demand. So we'll get back to pricing power. Secondly, on rates, think about the businesses that you own or might be looking at that carry a lot of debt. Think about a business like Transurban, for example. It's a toll road business in theory. I like to think of it more as a loan with a toll road attached. They're almost in the business of debt rather than the business of running roads. It's a bit flippant, but you get the idea. If you think about the way that Transurban operates, the sheer burden of that debt as rates rise, will it be able to keep ahead of that? Maybe. They've got inflation link, but remember the inflation link is to the sales, not to the costs. So that goes up. What happens to that P&L? Now, I don't have a really strong view. It's hard to know for sure because we don't know how fast rates go up, how high they go, how long they stay high. But be mindful of business with a lot of debt. So that's important for rates as well. And then think about the consumer response and the business response. Which businesses are going to be in more demand, less demand, or the same amount of demand? And that's important. But here's one that people don't often look to or look through, is these economic conditions. Let's say we have a meaningful downturn. Let's even call it a recession. I hate using the word, let's call it recession, for 9 months, pick a number, 3 quarters. At the other end of that, if those businesses remain in business, if they remain strong, fundamentally attractive places to shop or businesses to do business with, not investments, but operating businesses, then the customers are very, very likely to return. If and when they do return, profits go back to previous levels, probably higher than that. There are a lot of people looking at businesses, and particularly retail right now, and saying, hey, as we go forward, there might be a recession coming, so therefore I should sell my retail stocks. Well, maybe. But if you're a long-term investor, if you're a 3, 5, 7, 10-year investor, hopefully longer, by the way, I hope to own all of my stocks for a decade or more if they keep doing their job, then it's the earnings power in those years that matters more than what we might go through in the short term. And if shares are being priced for the short-term challenges, but not the long-term opportunities, as retail investors, as average people who aren't running funds or something else, we've got a spectacular opportunity to basically take that and say, great, let's go and make something of this. Let's take that opportunity of a short-sighted market, desperately looking at the thing just ahead of us, and missing the longer term opportunity. If that sounds like the COVID crash to you, then you're on the right track. It won't be as sudden, it won't be as certain, it won't be as deep, but the recovery probably won't be as quick. But some of those share prices in the depths of March 2020 that recovered so incredibly quickly, if you get the opportunity to buy at those sort of levels, when the market's looking forward and saying, these retail businesses, these tech businesses, these growth businesses might have a tough 6 or 12 months ahead of them, maybe. If you own these businesses yourself, would you sell them today? No, you'd hold on. You say, well, the future's going to be okay. We've got a tough 12 months. Let's tighten the belt. We get the other side. Out the other side, we've got plans for growth. Let's keep doing our thing. It makes a lot of sense to me to think about investments, public companies, exactly the same way. So if you're getting offered a price that reflects short-term challenge, but you think the long-term opportunity is attractive, again, there might be some volatility in share price in the meantime, for all we know. Here's the other thing, and I'll get back to questions. I've got lots. Thanks, Arthur. Thanks, Sarah. Thanks, Mick. Thanks, 66. We will, no recommendations yet. You haven't just, after starting with. Okay, we'll go through that. Thanks, 66. Alex, thank you, mate. Retail e-commerce outlook. We're coming going on that one a bit. All right, thanks, Isabella. Okay, so, what was I going to say? What was I going to talk about? Don't know. Completely lost my mind. All right, let's move on. What I think we should be thinking about as investors is that long-term trajectory. There is no need to get obsessive over the short-term challenges. And that sounds weird, right? No one likes taking losses in their share portfolio. I've taken a few over the last 12 months. Some of my growthier companies, you mentioned Kogan up front, Wombat. Thank you for asking that question. We'll get to that, as I said. I've taken a big bath on that one so far. By the way, I didn't buy at the highest prices, but I certainly didn't buy at the lowest prices either. The question for Kogan is not, is it painful right now, or is it a problem right now, but rather long-term, is it an attractive business? Do the underlying economic characteristics of that business justify paying today's price for that company? If you want to think about it completely mathematically, the cash flows between now and whenever you sell, hopefully never, but maybe 10, 15, 20 years if you're lucky, what will the cash flow be for that business over that period of time based on the price I paid today? It's like someone buying a rental property and then selling it 6 months later because they've got 2 weeks of vacancy. It's just kind of like, the tenant might move out. Oh no, I better sell my share. I better sell my property then. You don't see investment properties being sold because the tenant might move out in 4 weeks' time. There might be a gap in the rentals. Oh no, that's terrible. People think, well, okay, there might be, and I'm going to have to put some more money in. But over time, if I'm getting a decent rent, then maybe that's a good thing to do. And I think that's a really nice analogy when you starting to think about the way to imagine some of this long-term story. So let's get some of your questions. Wombat, is it time to give up on Kogan? Mate, I don't think it is. And I could be, so first thing I'll say is I'm as prone to anybody else of confirmation bias and hanging on too long and all of those things. It does come back in my mind to the point I was just making actually, which is simply, do I think what Kogan is going to be a bigger and better business, a more profitable business in the years ahead? I think the answer is yes. I don't think Kogan stopped growing its customer numbers over time. I don't think it's maximized the margin it's going to earn. I don't think it's got the pure benefits of scale. And by the way, last year was a mess. They said in their press release, I really admired this candor. I said this on Twitter yesterday or the day before. They said, we were wrong. We were wrong. Now, that shouldn't be unusual. That should be able to be expected by every ASX company, but of course we know it's not. They made some big mistakes. They had too much inventory. They paid too much for warehousing. They got, I won't say even carried away. They expected growth to continue for longer than it did. And it didn't. So again, the year-on-year stuff I started with, it's very hard to work out growth year on year. But the compound growth of Kogan, they're still signing up more customers, more people on the mailing list, more people for Kogan first. I'm a shareholder, you know that. I do think I think the future is attractive. I do think they will get to a level of sales and profitability as they get to operational efficiency, which is their new catchphrase and probably should be. They've already said, by the way, that the costs in the first month, I think it was, of the year were down 17.8%, something like that. So they're kind of showing evidence of getting ahead of this sort of problem. So I don't know what the story looks like. I hate using the Amazon example because it's Amazon, right? It's one out of the box. It's a very unusual business. I own shares in that, by the way, too, for full disclosure. But it was loss-making for a very, very, very long time. Now, Kogan is no Amazon. It wouldn't pretend to be. It's not. It's not big enough. It's not. It's not Amazon. But the whole idea of a business that grows scale, makes losses in the short term, and then turns those losses into profitable growth after that, I think is what will happen with Kogan. Now, as I said, I could be wrong. I always will say to everybody, buy any company, any shares in a diversified portfolio. So if you're wrong about one, it's not going to wreck your portfolio. If you're right, then you get some upside. So yes, I like Kogan. I own Kogan. We've recommended Kogan. It's a buy still. I think the long-term story is an attractive one, despite the combination of COVID impacts and frankly their own mismanagement. I think that's fair. I mean that in a critical way. Just they made mistakes. They said that. And so I think that's the story with Kogan. Andrew, thank you for your kind words. Tony, is Domino's still a hold and top up? Yes, it's still a buy for us at Motley Fool Share Advisor. A little bit of behind the scenes there. I'm not sure if you remember. By the way, g'day to everyone who's joined us, whether you're a member, whether you're a reader, whether you're a social media follower. thanks for spending some time with us. This is just a chance to go through some thoughts and share that with you. So I will say Domino's is a personal holding of mine. It is a recommendation of Motley Fool Share Advisor. I thought the results were pretty good. They weren't spectacularly great, but the long-term story is still strong. They open more stores in more territories. They put prices up. I think it's a long-term winner, Domino's. I think it's one of the best-run businesses in the country. If you can run a franchise business that well, you're doing something right. I think Don May and the team there are doing a fantastic job. So I am a fan. I own shares. I think it's a buy, absolutely. Andrew asks, is it time to sell Woodside? Mate, that's a really, really difficult one. I haven't looked a lot at Woodside since it did the what do you call it? Since the BHP assets were spun into it. So it's a bit of a different business than it used to be, just because it's bigger and a bit more complex than it was. The hardest part with oil players is the oil price. I tend to, if I'm going to look at commodity companies, I want great operators, like quality operators, keeping costs low, injury time down, all that kind of stuff. So I want that, and I want to buy those when the commodity itself is at a low relative to preferably the marginal cost of production. What does that mean? Let's take a theory, just a silly example. If it costs $10 to get a barrel out of the ground and the price is $15, $20, $25 a barrel, then the downside is not much, because they're not going to, for long at least, produce below cost. And there's a very good chance the price goes up over time. So you're maximizing your upside. If you were to buy at $100 a barrel and the cost is 10, well, there's every chance it falls below that, so your margins get compressed at some point. It doesn't make them bad businesses, just means you've got to be careful of the price you pay, because the commodity may well fall, and we know they can't do much about that. They've got their price takers, they have to accept it. So I don't love drillers at the best of times, to be really honest with you. Woodside probably the best on the ASX in terms of quality. So I'd probably, if I was going to do one, that probably be the one I look at for operational excellence. Again, I don't have a really strong view about the price and the time, I have to say. I'm sorry to not be able to answer that question as well as I'd like to. Wesley, take the offer and run for Nearmap. I would say to you that there's no hurry on this one. If the offer the share price was about $2.15 earlier. Let me have a quick look. Just do this live for fun. Nearmap share price is $2.10. The price is the takeover price. I don't think you'll lose much by waiting just to see for a week or so whether or not a bidder gets flushed out. It doesn't seem likely. It seems like the bid's a done deal. There's no point hanging on once the deal's done, because you're only going to wait for the money to come in. You might as well sell and then use those proceeds to invest in something else. I just don't think you need to rush these things. We kind of feel like we need to do something soon. That kind of uncertainty bubbling away in the background, our human brains don't do very well with it. But I really don't think you have to hurry this one. So I think it's one where you can say, look, it's at the offer price. It looks like the offer's going to go ahead. So there's no downside in waiting. If there is a bidder, maybe it's even a 10% chance, but hey, why rush it if you don't need to? So for me, I would not be selling in a hurry, but give yourself a week or two. At that point, if the deal's done, a deal's done. And you might as well take the money off the table, I reckon. Scrolling up now, here we go. Isabella, love the pod, Scott. Great to hear you live. Thank you, Isabella. It's very kind of you to say. Crack the sky, value investing Domino's is a buy. There you go. I agree. Retail e-commerce outlook from Alex. Alex, I think there's a challenge and opportunity. I think the retail story in the short to medium term is, for many retailers, probably challenging. So let's talk operationally rather than investing, right? It's really important to separate those two. I really like the value we're being offered, but that's probably because the short term could be a challenge. I feel like we're at an inflection point of sorts, and I don't know when that inflection point actually is. Maybe we're past it, maybe we're coming up to it. Rates are going up, inflation's gone up and still going up. That has to depress spending by definition, by very definition, because those who are benefiting from higher rates, the savers, aren't getting that much more of their money just yet. Those who are hurt by higher rates, the debt holders, home loan borrowers, effectively, having a lot of money taken out of their bank accounts. So that it must be a net negative relative to where we have been in the past in the short to medium term. That can't not be true. So honestly, I think retail as a category is probably going to grow more slowly than it has. I don't think it's going to decline necessarily, though. If the rest of the world goes into recession, it's very hard for us to imagine we could avoid it. So we may have to go down that path. If and when it happens, though, again, so do retail sales soften? Yes, probably, almost certainly. E-commerce is a really interesting one. Now, put Kogan aside for me for a second. I've talked about that one. I don't want to keep banging the drum on that. Let's talk about e-commerce, even as part of an omni-channel retail. Think about a JB, a Harvey Norman, and a Adairs. I own Harvey Norman and Adairs for the record. Plenty of others who have even Maya, doing really, really well online. And I think e-commerce as a function of retail continues to grow because it's really small. I mean, it's growing. It's nice. It's, some retailers now it's 25%, 30%, but it's still a minority and a decent minority. So over time, I think e-commerce continues to grow even as retail growth slows. Back in the day, go back to the GFC, Flexi Group, a business is on the nose these days, but back in the old rent, try, buy things, the old Harvey Norman 60 months interest-free promos, they were growing like topsy, even when the economy was shrinking. Why? Because they were taking market share. They were going into more and more and more of these places. More retailers were using them, more consumers were using them. So even though retail sales were coming down, and only for a little bit, only for a short while, Flexi Group took a greater share of that smaller pie. And so it was able to grow. And I think that's going to continue to happen. So be mindful of that. I think e-commerce's future is super bright, by the way. I think, I don't know how many years it is till we shop majority online, but if we're not shopping at least 2/3 online in 15 years, I'll be really surprised. There'll always be a place for physical retail. People want to meet, they want to browse, they want to window shop, they want a day out, they want to try things on. That's always going to be true. But the pace of, I mean, the iPhone's, 11, 12 years old. Think about like just the sheer change in that period of time. They go forward 12 years or 15 years. To imagine that won't be that, I think is probably hard to believe. So I'm massively bullish on e-commerce. Generally, I own Amazon, I own Kogan, as you know, so I own some e-commerce pure play retailers. But even e-commerce within some of those other retailers, I think it is going to be a bright spot of retail in the economy for a long time to come. I'd be very bullish on the growth of e-commerce. Okay. Any recommendations for starting with? So I'm not sure what you say. You just joined up for me. I'm not sure what you might be in the service or the video or the live stream. Beginning investors, look at ETFs, exchange traded funds. Buy a couple of really broad, diversified ETFs. Why? Because you're getting massive exposure to the whole market. You're getting the average return minus a tiny fee. I'm talking about the index ones, by the way, a Vanguard ASX 300, for example, or a Vanguard Global. I own the global ETFs. The VGS is the code on the ASX. VAS is the ASX 300 on the ASX. It gives you diversification, super low cost, and one volatile share is not going to impact your finances or, more importantly, your emotions. If you buy one stock as your first share you buy, and then it goes down 3 weeks later, you're thinking, oh, this is terrible. What a terrible thing. I'm never going to do this again. You get discouraged. You get put off. Maybe you give up. I want people to start and keep going, keep building. So start with some ETFs. I think it's a great idea. Individual companies. I own a company called Sol Pattinson. Washington H. Sol Pattinson is the full name. SOL is the code. One of the very best businesses on the ASX, 100 and something years old, diversified listed investment company, run by some really great managers who I like a lot. Rob Milton and the team and Todd Barlow do a wonderful job there. So yeah, I like that a lot. They're three great places to start. Not very sexy stocks. I'm not going to give you the next big growth stocks. I just buy that one. I think that'd be irresponsible. Just build a portfolio. By means, add some growth stocks. I've got some, but just be careful. As you're starting out, start with a solid base and then build on top of that. And that's where you start to add some of the spicier stuff over that. Okay, Mick, mate, very specific question about MLD and NRW. I don't know the answer to that one, Mick. I don't follow it closely enough. Takeovers are a funny thing. Let me do a really quick vignette on takeovers. Back to Nearmap. In a perfect world, a management team and a board would have a sense of what the business was worth, independent of the share price on the exchange. And that's strange for some people because I'm saying, it's selling for, let's take Nearmap, selling for $1.80 or something, I think, before the takeover. Selling for $1.80, therefore it's worth that, right? So if anyone offers you $2.10, it must be a better deal. It must be a good price. You must want to take it. That can be true. Remember, of course, that a couple of examples. Qantas in 2007, there was an aborted takeover for about the same price as the shares currently trade for today. So that was a long time, 15 years in the wilderness with almost no return. It might be like a 1%, 2% annual return, something like that. Since then, they should have taken the money and run. They were being offered something that was worth way more than the company itself. On the flip side, a business like Altium, for example, knocked back a takeover and said, hey, we think the business is simply worth more. We think the market is undervaluing this business, and we're going to put our money where our mouth is and say, stick with us. We're going to build this business and make it bigger. And so it's risky in both areas. If you take a deal, you miss the upside potential. If you knock back a deal, you risk the shares falling again. And that's what happened to Altium in the short term. But if you have a business that you think is a really great long-term business, you don't want to sell it too cheaply. I don't know the situation, the one you've raised. I would hope if they knocked it back, it was because they looked at the business and objectively, realistically, they're two important words, thought this is worth more. Not because of ego, not because of hubris, but genuinely went, hang on, either we're being offered a crazy low price or the shares are temporarily in the doldrums. those are the times when you want to say to a potential takeover suitor, no, thank you. You're being opportunistic. Good on you for trying, but no, we're going to hold out and prove out the value. And I wish more companies would do that, quite honestly. It's too tempting for most directors and boards to say, a little bit more, sure, I'll take the money. I look like I'm adding value for shareholders. It limits my downside risk, and talk about career risk if you're a director. You want to be able to say, look, I did this takeover. I got this away. We made this money for shareholders. I don't mean to sound overly skeptical, but the reality is I would rather have a board who says, we think the company is worth X, whatever it is. And if you're not going to give us that, we're not going to sell it to you because we think it's worth more. Yeah, Sarah asks about the Asia ETF. This is the Asian Tigers ETF. It's been hit by a couple of things, Sarah. Obviously, geopolitics has been really painful. We know, of course, the Chinese tensions, China, Taiwan, the US, all that kind of stuff that's ongoing. Plus, the market's hating growth stocks right now. That's a bad combination. I own this ETF as well. It's a small position in my portfolio. Thoughts on when it rebounds? No idea. One of the beauties, if you've been with us for any length of time, you know that I'm allowed to say I don't know. Many other people in my position have to pretend they do know or have a view. What share prices rebound is pure guesswork. It honestly is pure guesswork, mate. No one can know. I'm fond of saying they're either lying to you or lying to themselves, or maybe both. It's impossible to know. I don't love the ETF. I own it because I want some geographic and industry diversification. I don't have any exposure to Asia other than through this ETF. I do expect that in 15 years' time, maybe one or two of the top 10 businesses in the world by market cap are Asian-based businesses. Why? Because the population is there, the development, the research, the funding is there. It just makes logical sense. More than 1 billion people in both India and China, more than 1 billion people in Indonesia. To imagine that what's almost half the world's population in 3 countries there, they won't have one of the best or biggest businesses in the world. The odds are almost, the odds are against that not being true. So I think it's an attractive way to have some exposure to that market. I wouldn't be overweight in it. I wouldn't be buying it for a tactical or kind of a undervalued to overvalued. I hope to own that ETF for a while, as long as it continues to play out. If the companies in there don't continue to be attractive enough, or I think maybe there's a permanent change, I might look to sell, but I can't imagine myself selling it. But by the same token, I have no view on when it's going to rebound. I think it's one of those stories of I buy it for diversification specifically rather than for a stock picking benefit. I haven't said I love these particular companies at this particular price, so it's obviously good value. So yeah, I don't know in general when things are going to rebound. I certainly don't know for the Asian Tigers ETF. I'm sorry to say that, Sarah. Nick Scarley. I like Nick Scarley, Arthur. They've done a spectacular job of running a really, really great business. They've made every post a winner. One of those companies that has just, tweaking a business model, really refining a business model. Doesn't get the credit it deserves. Often the new thing, the exciting thing, the big thing, the next Afterpay or the next whatever, the next buy now, pay later, the next graphene miner, the next lithium player. We love themes as humans. Sometimes just doing the same thing, just incrementally getting better and better and better is where most value is created, but it gets less attention. They've done a wonderful job. I don't love the share price, and I don't know how much of their current level of success, profit growth, whatever, is cyclical and how much is structural. I think I'd probably want to buy it at a cheaper price if I was going to. I'm just looking it up now, mate. Apologies for turning around here. I've got the computer down here, as I said before when we started. Yeah. Look, it's only 12 times earnings, mate. I think here's the other thing I would say. I think a basket of retail will do really well. If you bought a basket of, retailers that with a P under 12, like Nick Scarley and others, I think you'll do really well. I would have no problems buying Nick Scarley at the current price. I just am not 100% sure what the growth trajectory looks like. We know that they've struggled with supply chain costs, as everyone has. This is the thing, I don't think those are permanent, right? So if you kind of go forward and say, when that gets sorted, is this a more profitable business? I think the answer has got to be yes. The question I don't know the answer to is the demand story. I don't know how much of that demand is cyclical over the last few years of house price growth, nesting, the whole idea of, we all kind of got new couches on TVs because we couldn't go overseas. That really was a real thing. So I don't really have a strong view, again, of that underlying earnings power I talked about, but I'd be surprised if it didn't hold its own, put it that way. I don't know that it's massively a market beater, but I'd be surprised it doesn't hold its own. Shanhawk. I've heard an analyst trash Aussie ETFs because of the concentration of financials and materials. I mentioned Soul Pat's a preferable alternative. You may have heard me do that. I wouldn't say I've trashed the ETFs, but I've certainly told people to be a little bit careful. I'll tell you something. I own Soul Pat's. I also own the Vanguard Small Ordinaries ETF. It's VSO is the code. I'm not saying it's a recommendation, I'm saying I own it. And I don't own the Vanguard All Australian, the ASX 300, the VAS. And the reason is exactly the reason you point out, that the ASX is more than half banks and miners, 54% last time I checked. It does vary a little bit depending on how the bank share prices go. If you're buying a passive ETF, and I love passive ETFs, and by the way, if you want to buy the ASX 300 ETF, go for it. I don't think it's a terrible investment at all. I'd be more than happy for people to do it. I'm not trying to dissuade anyone from doing it. But I do think if you look at that and say, the idea behind a passive index ETF is broad, diversified, whole exchange, low cost. It's a great way to get the total market return. The problem I have is the Australian market is, as you suggest, massively dominated, massively overweight with those two sectors. And so what that means is where the banks go, where the miners go, goes the whole market, and therefore goes that ETF. It's not necessarily, it could be a great thing, by the way. The banks and miners could fly from here, and it could be the best investment ever. But it's not passive diversified ETF in the way that the US S&P 500 might be, for example. So for me, I own Solpats. I also own the Vanguard Small Ordinaries, which is the All Ords without the top. I think it's 100 stocks. I can't remember exactly, something like that. So I want the growth of the broad market, but I don't want that massive mega cap exposure where it's super overweight those big banks and big miners. By the way, that's been a losing bet over the past 3 or 5 years, I think. So it doesn't mean it's necessarily going to work out. I just feel better about it because I don't want massive exposure to those two sectors. So I just choose not to. Now, I've got lots of individual stocks, by the way. It's not the only thing I own or even a major part of my portfolio. So I own Solpats, yes, and for the reason you say, love it. Not super diversified either, by the way, but pretty diversified. Everything from telcos to coal mines to internal property trusts, funds management, all sorts of stuff. So pretty diversified, but not kind of market matching diversification, if that makes sense. So I like Solpats a lot. I've owned it for years. I expect to own it for years. And I like the Vanguard Small Ordinaries. But I also I choose not to own VAS or any of the BlackRock's got an A200 ETF, same sort of thing. I wouldn't hate owning that. If I owned it, I wouldn't be rushing to sell it. Isabella, Webjet outlook. Oh, great question. I love Webjet's management. They've done a really, really good job, but they got absolutely blindsided by two things. The first is COVID. We all did. Secondly, they were too aggressive on their balance sheet. In hindsight, easy to say, they didn't have enough cash. They had to dilute shareholders 2 for 1 to actually stay alive. And they did, and that's been fine. The Webjet share price, though, I think you'll find, here's one of the things if you look at share price charts. I hope you can hear me on a turn around, guys, sorry. The Webjet share price chart over 5 years, as I pull this up, the share price is now $5. Pre-COVID, just before, it was $10. So you say, okay, half the price. When it goes back to that price, so it's only going to get back to that price and I double my money, right? The problem is that it's got twice as many shares on issue now. So the market cap, the market value of Webjet is the same now as it was then. It's effectively recovered all of that value. The problem is there's twice as many shares on issue. So the upside opportunity isn't as big, as it might look, because it can't go back to $10 easily. By the time it gets back to $10, the business will be twice as big as it was. Now, I like Webjet. I like John Gusick, who runs that business. I own shares in Webjet. I'm sorry, people keep asking me about shares, companies I own. So I have to say, not me to talk my book. They're your questions. I'm taking them in order. So yes, I think it's a good underlying business. They crueled themselves by being too aggressive on a balance sheet level. They had to issue shares to stay alive, better than going broke. So it's still a win. From here, the upside isn't super obvious. I do like the fact that we're getting back in the air. Qantas announced today that they had 103% of pre-COVID volumes in June of this year. In other words, 3% higher than pre-COVID. So we're back in the air. I think it's good news for Webjet. I like the business. It's on hold for us at the moment at Share Advisor because we don't want to see how that plays out, both in terms of value and in terms of the market. But I like the business. I wouldn't rush out to buy it. It's not obviously cheap, but I'd like to see their results as they come out. Excuse me. ResMed. I like ResMed a lot. I think it's one of the very few businesses with super multi-decade tailwinds. Why do I say that? ResMed does sleep apnea and respirators. We're going to have more respirators used and sold because medical technology is continuing to improve. We have new and better ways of looking after people. That's a great thing. Second, we have more people who are getting fatter and frankly having more obstructive sleep apnea. I don't mean to be unkind about that. I'm not a slim bloke myself, so I'm not exactly pointing fingers at anybody else. I expect as the world continues to become more developed, affluent, then the disease of obesity becomes a more prevalent issue. And I think as a result, we'll end up with more people who have the need for ResMed's machines and devices. Now, there may be alternative treatments. The big risk is there's some genetic treatment or something else that cuts the legs out from under ResMed. You don't have to treat something if you can cure it. So that is probably the biggest risk. But I think it and Cochlear have multi-decade track records, opportunities. Sorry, just be mindful, be careful of if we do end up with cures or potential better treatments. So genetic therapy, for example, that's what I'd be looking a little bit carefully to make sure the business isn't being eroded. But you'll see that coming. It's miles away, I think. I think these guys are multi-decade winners in all probability. Michael, does Motley Fool see any areas of value in ASX healthcare currently? It's a very good question, mate. Healthcare is really challenging because as a theme, as a societal, we're talking about ResMed. So ResMed is, yes, absolutely. Nanosonics, I quite like, and a lot of the guys like. It does ultrasound probes, disinfectant devices for ultrasound probes, really good business. Like both of those. I don't think we have any others I can think of. Most of the big healthcare companies are very, very, very capital intensive. Ramsay Healthcare, we've got on hold at Share Advisor. It's just been a bit disappointing. The growth isn't there, really capital heavy, as you'd expect. So a lot of these guys are, it's not, healthcare is growing, but the cost of running healthcare is also growing. So the margins aren't necessarily there, and the volumes aren't necessarily growing fast enough to offset the capital cost. So I like Nanosonics, I like ResMed, I like Cochlear, so yeah, that one as well. Probably some others. I actually quite like NIB, which is health insurance, and insurance and a healthcare company, but I'll throw that one in because I own it. Again, we've recommended it. I like that one. Other than that, I'm not sure we have any other healthcare on our scorecards. We may. If we do, someone will let me know, probably, hopefully via Slack or something, I can let you know. But yeah, that's probably the best answer for you so far. Michael, thank you. Andy, beaten down tech stocks. Oh, you asked about Zip and NextDC. So here's the problem with beaten down tech stocks. It's a single vibe, a single theme, a single description. I think they're really, really different businesses. These are, so yeah, beaten down tech goes for everything from Nuix through to NextDC and, everywhere. Technology One, they've all kind of been whacked with the stick on the way through. So let me address them separately. Zip, I'm not a big fan of, mate. Apologies if you own it or like it. I am not a huge fan of buy now, pay later as a concept, as a product. There's a saying that I'm pretty sure I've stolen from somebody else, but I've never been able to find, which is when your product becomes someone else's feature, you're in trouble, right? When cameras become part of phones, you're not going to sell as many cameras. I think buy now, pay later as a feature, as a thing, becomes a feature of transaction accounts. PayPal offers it, for example. Some banks now, I think Bank of Queensland offers as part of what they're doing. It's going to become a feature of other financial products. And so why do you need a standalone thing like buy now, pay later? Even if I'm wrong about that, the big guys are probably going to win. How many buy now, pay later providers do you need? Do you need Afterpay plus ZipPay plus OpenPay plus Sezzle plus Hum plus, I can't remember the other ones now. It's something like 8 or 9, or there were buy now, pay later companies listed on the ASX. When you think there's only 3 large credit card companies globally, the chance we have 9 buy now, pay later providers that survive is very likely. Now, they could get taken over by Afterpay. They could get bought out. They could be a great, they could just get lucky. A Godfather offer from somebody at a good price. Hey, made some money back. So I don't hate them necessarily. I don't see big upside. There's no structural upside potential. No potential. That's a bad way to say it. There's always potential, right? I think the probability of meaningful upside is probably reasonably low, particularly as we go into a higher interest rate environment. NextDC is funny. I've been wrong about NextDC for years, so I'll put that out front of my next view, so you can take that with a grain of salt. NextDC data centers generally are warehouses full of computers with a cable that leads to the rest of the internet, and that is super, super oversimplified and ridiculously so. But I don't know what competitive advantage NextDC continues to have over time. The best opportunity they have is that the other international players say, we won't go to Australia, NextDC has got it covered. In which case they can keep charging very high margins and make a lot of money for shareholders, which would be great. It's very, very rare that high margins persist in an industry for very long if there are deep-pocketed competitors who want part of your business. And if and when that starts to happen, other players arrive in Australia and say, we would like to set up some data centers here, thank you very much. Now, there is some geographic benefit if you're closer to exchanges, closer to the ASX, for example, or closer to the CBDs, for those companies where absolute speed, like millisecond speed matters. nanoseconds, whatever they are, then they're there first. That's probably a good thing to be. I just don't know. I can't. Sometimes in investing, it's okay to just take a pass. And for me, I'm not 100% sure that I understand why these guys would be able to maintain those sort of margins when there are other competitors who can come and take that business away from them, or simply just add more business and drive prices down. So I've never been a fan. Now, I've been wrong for years. So again, it's one of those ones I've not said I would never short it, for example. I'm not sure it can't make any money. I'm just not sure that it can continue to be profitable for the long term. What's that profitable again? Profitable enough, this level of profit for the long term. I think it'll always be profitable, but if the margins get pushed down, then your returns as a shareholder probably go down too. Whisper seems to be, I'll scroll past here, sorry. Here, Whisper seems to be doing well, but share price is floundering. Yeah, I think, Michael, that's the tech stock problem. I think, investors are hating on tech and hating on retail right now. And I think that's an opportunity, by the way. If you're not making money or you're marginal, then I wouldn't necessarily say it's the same sized opportunity for every company that's in this situation. Some are beaten down because they deserve to be, because the share price was too high to start with. Others are, in that sort of maybe not range. Others are just obviously, I think, really cheap. But trying to work out which is which and what the future might look like is the hard part. What I do know is that they're more attractive now than they were then. If you look at beaten down, particularly tech, look at cash burn. Make sure they are either profitable or they have enough cash to see themselves through multiple months, preferably more than 12 months of cash burn, because capital's going to be harder to raise, which is why the market hates it. And also the fact you've got to wait longer for those profits to come through, and a higher rate environment, that's a higher opportunity cost. And so that's why, and justifiably to some degree, the market's re-rated. I hate that term, but it is what it is. Has pushed down some of the prices of some of these tech companies. Some will bounce back. We will look, I am reasonably sure, we look back at August 2022 and say, man, that company was that cheap. I just don't know which ones it's going to be. If you're looking for a way to play that, I think a group of companies that kind of have those characteristics, knowing you'll be right about some, wrong about some, maybe some will be middling. It lowers your absolute possible return. It also lowers your absolute possible risk. So I'd be thinking some way about that sort of stuff. Flight Centre taking a hammering today. Yeah, they have. Do I see them as a rebound stock and worth keeping for another 12 months? I don't know about 12 months, Henrik. I don't do short-term price targets, so I have no idea. I like Flight Centre. I think they will continue to rebound nicely out of this. Screw Turner is one of the best in the business. If anyone can make it work, he can. I see no reason. I think frankly, COVID didn't do them a favor. They were clever. The old saying, don't waste a good crisis. They cut a whole lot of costs. They're really bare bones now. That gives them a chance to really grow nicely and restage the growth. They probably had too many outlets. They probably had too many shop fronts. They've cut those back massively. So I think kind of keep growing profitably from there. It's a hold for us at Share Advisor. So is Webjet, so is Corporate Travel Management. I own Corporate Travel because we just want to wait and see how that plays out. We knew they were too cheap back in the day. What are they now? They're cheap enough now? Open question. I think they are. I think they're worth holding on to. I don't know about the 12 months, mate. I can't see where the price is going to be at this time next year, but I think they're a long-term market beater. Probably. The reason they're on hold is we're just not sure, and it may not be the case. So they're in that kind of wait and see phase. If we thought they were market beater with confidence, they'd be buyers right now. That's how we do it at Share Advisor. If I thought they were definitely going to lose, it'd be a sell. So they're kind of in that weird situation of both. I'm not sure, and we want to see a bit more water under the bridge before we have a chance to reevaluate their underlying earnings power in this new post-COVID world. But travel's back. The numbers are going through the roof. So I'm quietly optimistic. Megaport. I like Megaport a lot, Peter, as a business. It's a smart strategy. If you can fractionalize something, you can charge a lot more for it. One hand, that can sound like gouging. If you had to buy a whole pipe, it costs you a certain amount of money. No one wants to pay that amount. So you break it up into bits, but each piece you can sell for higher than the whole lot because people are buying smaller pieces. It's a strategy that's pursued a lot of the time through a lot of places. You can basically sell more than the entire capacity for a higher price because people use that capacity at different times, different amounts, different speeds. It's a really, really nice strategy of just fractionalizing that cost. So I like this strategy a lot. Not out of the woods yet in terms of final levels of profitability and growth. So super risky. I don't own it. I haven't recommended it for Share Advisor. It's too risky for Share Advisor. Some of the other guys in the team do like it, and with justifiable reason. So I would say on behalf of the team, I think it's a positive. I think Megaport's probably got a hopefully bright future, but there is a decent chunk of risk you're taking, and this one could go either way. But on balance, probably more likely a win than a loss, I would think. Joseph, hi Scott, thank you, mate. Thoughts on Min and Tyre? Okay, Min Mineral Resources, I don't have a strong view on. I don't love miners generally, mate. These guys are mining contractors. They're not quite miners. They're an interesting business. They are probably, if there is a Frankenstein's monster between mining and mining services, it's Mineral Resources. And I mean that in a kind way, by the way, not in a negative way, because they do seem to be the best of both. They're really well run. I like the business a lot. I don't have an investment view on it, but there are many, many worse businesses on the ASX. Tyro is a buy for us. This is another one that's been absolutely smashed by the market for probably not a great reason. Growth had come off a little bit versus what the market was expecting. So you expect the price to fall somewhat. It's fallen a long, long, long way. I think unjustifiably. If these guys can survive, I think they'll thrive. So the if is important. If they can survive, they're not making money yet. So they've got to get to that point. And again, the same comments I made before about tech apply to Tyro. If they run out of cash before they get scale, it's going to be one of these woulda, coulda, shoulda scenarios. If they can get through that, through the valley of death, I think they'll come out the other side pretty bright. I'm seeing more and more Tyro machines out there. I don't own shares, by the way. I think it's an attractive way to grow a piece of business. Very capital intensive. Got to get to scale, and we're talking mega scale. We're talking bank size scale here. So it's a long part, but I think they can do it. And the share price right now, particularly after the falls, I think is attractive. CSL, a growth stock. Ooh. CSL is one of those businesses, Raptor, that I think it's hard to predict because medical technology moves so quickly. Why I have never recommended it is for exactly the same reason, by the way. So the reason I wouldn't hate it is the reason I wouldn't buy it, which is I can't see the future out that far. It is so big, so massive right now that to get enough growth to move the dial, it's got to find big things to do, right? If you're, it's a good example. If you're a trucking company, when you go from one truck to two, you double your fleet, right? So you're going to get massive upside. If you've got 1,000 trucks, adding one more truck takes you from 1,000 to 1,001. It's not going to move the dial. So 1 to 2, massive. 1,000 to 1,001, not much. So for CSL to grow, it's going to take that 1,000 trucks to 1,200 trucks or 1,500 trucks. And that journey, it's hard for me to know how and why they get that done. So I put it in the too hard basket. I don't know. Medical technology is moving on wonderfully. I hope desperately they find lots of wonderful treatments for lots of incurable diseases and treatment, cures and treatments for those things. And the future is bright for everybody. I hope they win. I hope they win big. I hope they do fantastically. I just don't have the visibility on that business to know. If you buy it at the current price, you almost have to do it saying, I don't know. Hopefully they do. They've got some smart people there. They're putting a truckload of money in R&D. Hopefully that's enough. That's not an unreasonable assessment, by the way. My general view for our members is if I can't explain why it's going to win, I struggle to invest in or recommend an investment in it. Because if someone says, why did you think they were going to do that? What did you assume was going to happen? If my best answer is, I just kind of hope they'd keep growing, not enough, I don't think, for me personally, to feel good about a recommendation. So I wouldn't criticize anyone for holding it. I may well be entirely wrong. I'd just be a little bit careful. Ramsay, talk about Ramsay already a little bit. It's a hold for us, a bit disappointing in terms of results. They haven't been able to really generate the growth. A bit like the CSL problem, honestly. They're so big already. There's so many hospitals. They've got to do some big deals and get some really strong organic growth. It's just been disappointing they haven't done it, and the shares aren't cheap enough to make it a buy for me. We kind of got lots of questions here. Not too many, that's good. We'll go to all that 4 o'clock local time, guys, about another 12 minutes, if that's okay with everybody. Thank you for sticking with us. Thanks for hanging out. Really appreciate it. What's your portfolio weighting for ETFs to individual stocks? Or do you have a general recommendation on what an appropriate weighting would be? Thanks, love your work, from Jared. That's a great question. For mine, across my portfolio, it's probably 10%, maybe 15% ETFs. I own a few. I own the NASDAQ ETF. I own the Vanguard Small Ordinaries. I own the Asia ETF. I own Vanguard Global ETF. They're the only ones I own. I think we've got a separate account for my young bloke. It's a little bit of money there for him when he gets older. There might be a Vanguard Total US Market. I can't remember exactly. Which got that on autopilot, so it does its thing. But in my portfolio, probably 10 to 15%. Recommended weighting depends on what sort of stock picker you are. If you don't want to pick stocks at all, 100% ETFs is spectacularly good. One quick caveat. I don't want to take too long because I'm running out of time. ETFs ain't ETFs. The old Castrol ad, oils ain't oils. ETF used to mean broad, passive, low-cost, index-based fund. So it's the index fund in exchange-traded form. The Vanguard ASX 200, ASX 300, sorry, the beta shares ASX 200, the whatever, NASDAQ 100. These days, any fund that's traded on an exchange is called an ETF, and it should be. That's the right term. But I can charge 15% for a double leveraged bare gold and oil ETF, and it's still an ETF. That's not the same, of course, as an index ETF. So when I talk ETFs, almost exclusively, I'm talking about the broad, passive, index-based, low-cost. I use those terms over and over again because they're real. I want to drill them really hard into your brains. That's what I'm talking about. So if someone doesn't want to pick stocks, 100% ETFs is fantastic. Great, perfect. If you're starting out, start with ETFs, then add individual stocks on top of that. Perfect. If you're someone who invests, for example, only on the ASX, then using an ETF to get exposure to the US is great. And you might want more of that because you're not buying individual US stocks, for example. Remember, of course, the ASX is 2% of the world's capital markets, 2%. The US is 60%. And to imagine the best ideas are just in Australia, that 2%, I've said before, it's like going to a real estate agent and saying, I want to buy a house, but I only want to look in streets starting with A. So you wouldn't do it, right? But saying, I want to buy stocks, but only in Australia. So the opportunity to buy, to get exposure to international markets, singular or plural, using ETFs is great. If you're going to do that, you might want to have a higher weighting just because you want a higher weighting to international stocks, for example. So no single answer. I hope that helps. There's no bad amount. There really isn't. The more risk averse you are, the more less confident you are with stock picking, the more you're worried about volatility of individual stocks, the more you stay up at night worrying about the price of something, the more ETFs you should have and the fewer individual stocks you should have. Any thoughts on Magellan Finish from Crack the Sky? Oh, this has been such a hard one. I want to love Magellan. It's a fund manager. They're great economics, massively beaten down. It's only going to turn around a little bit, right? And yet it hasn't. And I've been saved from myself. We might have recommended it at Share Advisor in the last few months if I hadn't been saved by the rest of the team. Are you sure, Scott? Are you sure? All right, fine. Let's give it a miss. Invariably, it's fallen from those prices. I want to like it. Fundamentally, I think it should do well. There's no reason to imagine it wouldn't. But I am mindful that to whatever degree the funds under management was the cult of Magellan, obviously about the cult of Hamish Douglas, the former CIO and CEO, to the extent to which that is where the money's coming from, it may not get back to those heights. And so the value, because it's fallen a long way, if the funds don't return, the value is not going to return either. I'm probably going to give this one a wide berth for now. Just watch it. Probably at least wait for the fund outflows to stop. There's no hurry, I don't think. Crypto from David Bloom. I don't love crypto at all, David. My followers, viewers, members know that. Other people on the team like crypto. Here's my thing. I don't hate it. For me, an investable asset, to call it investment grade, an investment grade asset has to have cash flows and preferably profits or future profits. I think trying to guess what the price of an asset might be. I don't own gold for the same reason, by the way. So crypto is no worse than gold, but I don't think it's any better than gold. It can be a store of value, maybe, although crypto is pretty volatile. But I don't own gold. And if I don't own gold, I should own crypto. And I think vice versa. I don't think there's any real justification for crypto if you're not going to own gold, for example, because the same thing applies in terms of the type of asset. Now, maybe there's more upside in crypto. There probably is. There's also more downside. I don't want to get that argument. For me, it's just, I should say, I own $100 worth of Bitcoin that I bought 7 years ago to follow along on the craze. So I have a Coinbase account on my phone. Bought $100 worth of Bitcoin 7 years ago. I haven't not sold it since. So I want to be clear, disclose I own some, but it was just a follow along experiment back in the day. I don't recommend it. I haven't bought any more. I don't think I'd buy any more anytime soon. So that's my view on that one. Tony asked for a good platform for US stocks. Heaps of them out there, mate. Heaps of them. I use Charles Schwab because I opened an account with Options Express back in 2010 or something, and it was bought out by Charles Schwab. So now I use Schwab. They're fine. They're great. Others of the guys use Saxo, Interactive Brokers. Some of the guys use Stake. Just be careful with Stake. They now have a opt-out stock lending, which I don't love. So bear that in mind. Who else? I saw ANZ apparently now have $0 US commissions. They're coming down a lot. So I don't think you go too far wrong. I check out Schwab because I use them, not because I think they're necessarily the best, but they've been fine for me and I don't know any better. So I'm happy with what I use. I would happily recommend it. $0 brokerage. You go a lot further wrong. But there's probably plenty of others out there as well. I think Sharesies does US brokerage. I think you can go try them. I do a little work with Sharesies for full disclosure. That's about it. Robert, hi Scott, love your work. Thank you, mate. What's your view on Renascore Resources? Given the EV market, it's currently trading at 20 cents, but fair value is over 40. Mate, if the fair value has been calculated over 40 and it's worth 20, then it's a screaming buy. The question, of course, is the assumptions go into that 40-cent fair value. I don't know the business, mate. I wish I did. I wish I'd give you a view. I am cautious on lithium because I think a lot of investors are looking at the demand side, not the supply side. I've given this example before. Over the 20th century, I've written about this. If you want to Google Scott Phillips oil prices trend lithium, maybe it might give you a result. The price of oil in real terms after inflation went up 2.5 times in the entire 20th century, despite the volume just exploding, right? The answer was that the demand was met with more supply. I don't know the lithium market well enough to know, but what I would say is don't get caught up with just the demand side and forget the supply side, because if supply comes on stream, the price of lithium comes down. Even if demand does keep going up, it doesn't mean there's necessarily a fortune to be made in lithium mining. So I don't know Rediscore Resources. You may well be right, mate. In which case, go for it. If it's worth more than 40 cents and it's trading for 20, then if your assessment of value is fair, then there's a double on your hands, and so that's good options. But just be careful with that one. Can I slow down a bit? Thank you. Sorry, Mr. Spiker. I'm trying to get through time. I speak too fast anyway. Sorry. I will try. Maybe replay me on half speed or something. Kay asked for my thoughts on PointsBet and NXL. I don't know what NXL is. Is that Nuix? I'm not our best. I'm not our best judge of PointsBet. Some of the guys like it a lot. I like the opportunity that it has to be the picks and shovels play for the growth of online gambling in the US. The thematic seems really attractive. I don't have a strong view on the value. At $1 billion market cap, it's pretty pricey. A lot's expected from the business at that point. It has a lot to do to justify that price. So I like the theme. I like the idea. I think it's a smart way to play it. Am I sure it's going to be successful? No, but I'm not the right person to ask. There are other people on the team who know this company a lot better than I do, have more bullish views on it. Maybe they're right. Maybe I'm right. Maybe we're both wrong. So I think it's worth following for sure. Seems to be doing the right things. It's kind of a bit hit and miss based on the partnerships it makes in terms of it partners with certain agencies who try and win gambling licenses. If they win those licenses, PointsBet gets the business. If they don't, then of course there's no business to get. So it can be a little bit hit and miss from that perspective. NXL, I should know this code, but I don't. I have to say, my apologies. Someone's screaming at the computer now saying, Nuix. I wouldn't touch Nuix at the moment. I think there's too much mess going on there. I'd give it a miss. Maybe in hindsight, we'll look back and say, gee, it was cheap back then. So there's cheap with reason to believe there's significant upside, and there's cheap then in hindsight when you go, hey, who could have known? We tend to think that hindsight's 20/20, and it is. Right now, I don't think we can have a reasonably strong. I think we can assign strong probabilities. So that's why I'd be kind of giving that a miss. What's likely to happen with Nuix? Just that one. Thank you, Davis. Davis asked the same question as Kay. Got through that quickly. My thoughts on IGO. I don't really have strong thoughts. I don't. I'm not even going to try and give a view on this one. I don't know it well enough to have a view, and anything I said would not be couched in sufficient expertise to be helpful. And so I'd probably lead up the garden path inadvertently. Maybe the right way, maybe the wrong way. I'm not sure. I'm sorry, Joseph. I'd rather just say I don't know than try and give an answer. Visa and MasterCard, asked Walter. That's fascinating. Which one I recommend to buy? Mate, I don't reckon you go wrong buying either of them. These are two massively, massively dominant payment networks. I think the system is going to grow anyway. I don't think there's a strong likelihood that one takes meaningful share from the other over time. So I think it's more likely the status quo continues to apply. By the way, I think they make $1 squillion because the move to online payments right across e-commerce, tap and go, PayWave, ATM, excuse me, away from ATMs, I should say. I think it's going to be a continued trend. I think they'll both do really, really, really well. Honestly, I'd probably look at the relative PEs and buy the cheaper one. Just forced to choose, not because one of them was obviously a better business. Just because if you get two that are reasonably similar, I'd probably buy the cheaper one. They're two very, very, very good businesses. I like them a lot. I don't own either, by the way, for the record. Probably should. Sensible percentage in cash right now, back to 8% from 50%. John, I am a Warren Buffett acolyte, and I believe in his view of being caught with my pants up. I'm almost always fully invested. If I'm not happy. I hate having cash, not because I here's the thing, because I don't think we can know where the market's going next. More money is made avoiding the next crash than in the next crash, generally speaking, or loss, I should say. Those who went to cash in COVID normally didn't buy back in quickly enough and missed the entire recovery. Some really famous, smart investors missed out massively during the COVID crash because they kind of went to cash or didn't put the cash to work and then wondered after the fact. Market goes up over time. It goes up 2 years out of 3 on average. I'd rather have the money working for me. Mathematically, statistically, I'm more likely to win if I'm invested than not. If I'm good at market timing, then maybe I can do it differently. I don't know many people who are consistently good at market timing. So I'm almost always in cash. I'm not 100% in cash right now because I haven't invested some that I've got to invest. I just hate having cash. So I'm the wrong person to ask from that perspective, other than I think my view is reasonably well formed, which is if the market goes up over time, statistically, the longer you're out of the market, the better the chance you miss out, is my general view. Wesfarmers. I think it's Wesfarmers, yes. Worthy investment. Wesfarmers is a great business. Love it. Bunnings is the best retailer in the country by a country mile. Really good. Officeworks, pretty good. Some of the other businesses, not great. I like the conglomerate structure. I like the investment structure. I like the long-term thinking of that business. I don't think it's cheap enough to buy right now. So I like it as a business. Let me quickly look up the share price. I apologize to those who are hoping we're going to finish soon. We will. But I've got a couple of questions left, so I want to get through them if that's okay with everybody. Go if you want. If you're happy to hang around for another couple of minutes, we'll get through there. Wesfarmers PE 24. I think it's too expensive for what's not going to be a super fast-growing business. So I like it. I'd love to buy it at some point. I wouldn't be buying it at the current price. Lithium, I've gone through that. Thank you. Thanks, Elliot, for that question. Arthur, do I sell any stocks that do not perform as a long-term holder? Any specific time frame? Yes and no, Arthur. I don't sell anything based on the share price performance. We're always so tempted to say the shares are down, therefore I'm selling. The shares are up, I'm doing well. It's obvious, right? That's our portfolio result. It's real. It's true. If I sold the shares now, that's how much money I'd have. I don't use the share price performance at all as an indicator of what I should do with my investments. I look at the business and the current share price, not the historical or the trend or the chart, and just simply say, hey, is it worth the current price? My cost base for Kogan is about $6 something. It's down to $3.50 now. Do I feel great about that? No, I hate it. Do I think it's attractive? Yes. It's underperforming share price wise. But if I like the business long term, I don't let the share price tell me what to do. Any specific time frame? If the business itself was breaking, if the thesis wasn't playing out, then yeah, and no particular time frame, just when I think the thesis is broken. Lithium I did for Elliot. Scott Hutchison. Hey, Scott, I've owned Cochlear for 20 plus years and buy more in each downturn. Is it time to take profits? Is there much upside of the next 20 years? We've had that. I mentioned that before. There's not a heap of obvious price valuation upside, but I think this is a long-term compound. It's going to grind away, just grow and grow and grow and grow and grow. I would be very, very reluctant to part ways with Cochlear, particularly if I already owned it, particularly if I made some gains on it, had to pay tax if I sold. The chance of being able to sell, pay your taxes, and then reinvest that money in something else and get an even better return than Cochlear is going to give you, it increases the degree of difficulty over time. If I owned Cochlear, I'd sit on it. I think until you see the thesis breaking, valuation might go up and down from time to time, but I think this is again, short of a new treatment that undermines Cochlear's actual business model. I think this is a long-term, probably multi-decade compounder. I invested the COVID crash, as Andrew. A couple of my shares have tanked. Where do you suggest setting a stop loss? I don't do stop losses at all, ever. Stop losses are great for brokers. They tend to be not great for investors. Why? Firstly, you don't get stopped out at the price you want. If the price drops below that without going through it, so if it goes from 2 to 1, you set a stop loss at 150. If it ever trades at 150, you get stopped out at 1, not at 150. So if you have a big loss, you're not going to get a chance to stop that loss anyway. Then you sell it at $1. Well, why did you buy the shares? Unless there's something broken about the business itself, then all it's telling you is the market thinks it's cheaper. Now, if you still like it, you should want more of them at a cheaper price, not less of them. If I bought, take my house, right? Let's say I had a stop loss on my house. Let's say I bought a house for 800 grand. If the market fell 600 grand, I had a stop loss on my house. It was sold out from under me, but I still liked the house and I thought it was worth 800,000. I thought it was going to get back to that price. I'd buy the one next door for 600 grand rather than sell mine for 600 because the value is there. Setting stop losses just based on price, not business fundamentals, I think is a mistake personally. Don't do it. Never have. Andy, a lot of investing on the sidelines in cash. Do survive the cash is trash view. I've had that conversation. I don't like. So this is a Ray Dalio, cash is trash, inflation, blah blah blah. I think, by the way, inflation is going to hurt your cash, absolutely. But I don't not hold cash because of inflation fears. I just want to be invested. The opportunity for capitalism to grow my wealth is huge, and I want to be part of that rather than sitting on the sidelines trying to second guess it. But not for the cash is trash reason. Strider says VTS and VAS, so the Vanguard Total Market US plus Vanguard Australia, plus a blue chip or two like BHP and Macquarie. Can't complain with that. Plus your super with Aware International Equities to cover Europe and Asia. You can do that for sure. Thoughts on VGS? Michelle, I own it. I like it. I don't have a valuation view. It's a diversification view for me. I feel really good about owning it. Strider said VGS also good. Thank you. Perpetual hasn't exactly covered itself in glory, Carlos. I'm not a massive fan, but I wouldn't be hugely averse to it. There are other fund managers I like more. I own shares in Australian Ethical Investments. I think Pinnacle is probably a better bet, even though it's more expensive. TPG Telecom, we haven't recommended it, but I like it. One we kind of keep coming back to from time to time. It should have decent long-term potential. It's never going to be a huge grower, so price really matters on this one. The telecoms market's only going to grow at a certain rate, so you just want to be careful you buy it at the right price. Sonic Healthcare, Jesse, don't love it. Haven't looked at the price recently. Let me check. 12 times earnings, mate. Let me say I'm cautiously interested. I don't have a strong view on it. 2.6% dividend yield, P of 12. I'd have to look at the most recent numbers. I haven't done that. The most recent announcements to see what's driven that change. Share price down a lot, so maybe there's something going on there. I can't give you a really good answer, mate. I wish I could. I won't because I don't know well enough. But I'd certainly be keen to have a bit of a closer look. My issue probably is capital intensity, the amount of money that's actually in that business and how much is being soaked up by that company. Crack the Sky says Wesfarmers is more like a listed PE. It kind of is. I probably prefer Soul Patts for kind of similar reasons. The other business, by the way, if you after listed PE, Baylor Investments is one worth looking at. It's not a recommendation of mine. Ed Vesely from the Fool likes it a lot. A couple of other guys do too. Baylor is the company's name. BTI is the code. Really early stage tech investments. So it's been a rough ride recently. But these guys, 8 or 10 kind of major investments in businesses, hoping to turn those into real value. If you want PE exposure to that sort of part of the market, then that's something. Bet makers, Lucas, don't have a strong view, mate. I put it in the points bet camp, but I couldn't separate them well. Two standout companies for you during reporting season. So funnily enough, CommBank was excellent. I don't love the bank, so I'm not going to buy it. If you're asking for buys as a result, no, I'm not buying CommBank. Those numbers were astonishingly good. For a market that's concentrated by big four banks, astonishingly good. So that was really good. Centre Group was very good from a recovery perspective. WiseTech, probably the biggest one, 80% growth in profit. I think that was an astonishing result. They bounced back hugely. A reminder, by the way, that short theses don't always play out. If you remember the short thesis on the grief about WiseTech, back in the day, turns out good business doing really well. So that's probably the key. CommBank and WiseTech, probably the two. If you can make a 10 to 12% return on your money, long-term and minimize tax like salary sacrificing through super, you're laughing. Dead right. Strider. Bendigo and Adelaide Bank, Andy, probably prefer it to the other banks. BOQ is cheap. It's 9 times earnings, so I might lean that way if I was after really dirty value. Don't mind Bendigo, don't love it, don't buy it. Altium and their recent performance, that was also very good. Low way, very, very strong performance by Altium, really good result. Cheers for shout out, Scotty. Love your work. Thanks, Strider. Carlos, small caps should pay attention to. I mentioned Baylor. Put that on your list. Share Advisor does mainly medium and kind of largish caps. I don't have a lot of small caps in the portfolio there. I stay with Dubber and like Rising Stars 20 on micro caps. Dubber, I haven't followed closely enough, Paul, so I don't know the answer to that. I do know the guys like it. I'm pretty sure they're still big fans of it. So there's that. Right. We've gone over time. If you're still here are my 2 stocks. I should have gone back to this. I'm sorry. I didn't mean to drag it out. I was going to finish off with the question. I realized I hadn't done the 2 stocks yet. So I've got 2 things, 2 stocks and 1 offer. Here's the thing. If you want to join Motley Fool Share Advisor, if you had fun over the last hour, I run Motley Fool Share Advisor with a great team of people. If you want to join Motley Fool Share Advisor for a really cheap price, less than $3 a week, go to fool.com.au/live, LIVE. This is a Facebook live Q&A. So fool.com.au/live, and you can get access to Motley Fool Share Advisor for a stupidly cheap price, way too cheap for my mind, but I'm not the marketer. I'm not the price guy. I'm the investing guy. So yeah, check that out. No hard sell. But if you're interested, just have a look at the order page if you want to find out what we do. Fool.com.au/live, LIVE. Okay, my 2 stocks I'm going to buy. I own both of them, but I'm not going to buy any more until you have the chance to do so first. Once I mention the company publicly, I'm locked out for 2 full trading days. That means Friday and Monday, I can't buy them until at least Tuesday. No promises that I will, but I won't buy them before that. I'm going to buy them, by the way. I'm just not saying no promises on Tuesday. First is ARB. The code is ARB. It's the 4-wheel drive accessories manufacturer. I have spent way too much money at ARB on my cars. My wife will tell you that. These guys are a very, very well-run business. They have really good structural long-term demand growth in my mind, despite petrol prices, despite EVs. The number of 4-wheel drives being sold continue to grow and grow and grow. 4 out of the top 5 cars sold in Australia are 4-wheel drive utes. I think it's something like 8 out of the top 10 or 6 out of the top 10. It is a growth industry. Their order book is longer than historically has been. The price has come down a lot recently, $31 odd. The Brown brothers who run that business do a spectacularly good job. I really like this company. I think it's a high quality business, plenty of growth opportunities, aftermarket accessories, OEM, original equipment manufacturers, sales, both here and increasingly overseas as well. I own the shares. I think it's cheap. I'm going to buy some more ARB. Second one is a business we started with at the very top. You almost stole my thunder at the top. Who was that? It was Tony with his first question on Domino's, because the other company I'm going to buy is Domino's Pizza, DMP. I've already mentioned Dom May and the team there. He is the best, one of the most underrated CEOs. Him and Mark Fitzgibbon at NIB, probably the 2 most underrated CEOs on the ASX in my view. Not necessarily best, just most underrated. Domino's has a very, very good long-term growth trajectory. The growth numbers are messy. We talked about that before because of COVID. But they're going to grow their restaurant numbers here in Australia and New Zealand. They've announced moving into 3 Asian countries. They're already in Japan. They're already in Europe. I think this is going to be a business that continues to grow for years to come. Good same-store sales growth, good store count growth. That's going to generate lots and lots of sales and profit for Domino's and Domino's shareholders. I'm a big fan. I like the business very much. Bottom line, if you can find a quality business and the shares are available at a reasonable price, neither of these two are super cheap, by the way. They're not statistically cheap. We have some retail stocks, by the way, on Share Advisor. And not to put an ad, but some really cheap retailers out there. So if you are keen and you do join Share Advisor, you're already a member, check out the scorecard. There are some really cheap retailers that are well worth buying. But the two, ARB and Domino's. Phil, thank you for spending an hour and 12 minutes with me. I really appreciate it. Crack the Sky saying DMP has a long-term growth runway. It does. Andrew, thanks for your time, Scott. Enjoy your weekend. Thank you, mate. I've really enjoyed this chat. I hope you've enjoyed tuning in. If it's gone a little bit long, my apologies. If it hasn't gone too long, then great. I'm glad you're enjoying it. It's always fun for me to do. I love chatting with our members and our readers. And this is a really fun format to do it. So if you've got any feedback, let me know, by all means. You can subscribe to the YouTube channel, by the way. If you wouldn't mind doing that while you're here, we put out some stuff semi-regularly. So please do that. Again, if you want to have a look at an offer, don't have to join. Check out fool.com/live. Thank you, fools. By the way, if you do join Share Advisor, the next recommendation is coming out in 18 minutes. So there's an extra incentive if you wanted one. I'm saying that because I've got to check to make sure it all publishes at the right time. But hopefully, in about 18 minutes, the email goes out to our members to come and join us at Motley Fool Share Advisor. All right, that's it for me. Thank you for watching. Fool on.